Hello. I'm David Lagarde. This is Property Value. It is March 18th, 2022. Hope everyone's doing well. It's a channel where we talk about commercial real estate focused on South Florida. And the first article we're going to talk about today is Miami Hotel sees strong recovery. This article is on CoStar by Daryl Cronk, Director of Hospitality Analytics, South Florida. You want to check out his video, you can go over there and play it. We're just going to go over his highlights. After getting through the severe impacts of the pandemic in 2020, Miami enjoyed one of the industry's strongest rebounds in 2021. Miami is one of only 5 of the 40 largest hotel markets that posted 2021 revenue per available room, or RevPAR, an industry standard metric of hotel performance, at or above 2019 levels. The recovery in the Miami was led by strong rate growth, particularly on weekends. The rate spread between weekends and weekdays more than doubled, from 26 in 2016 to 59 last year. Overall, average daily rate, which measures the average rental revenue earned for an occupied room per day, rose 20% in 2021 to an all-time high of $223. Demand is forecast to surpass pre-pandemic levels this year thanks to the reopening of U.S. borders to international travel and the return of group business. Both ADR and RevPAR growth are expected to moderate from 2021's remarkable pace, but should still set new highs this year in 2022. Occupancy rates, however, aren't forecast to reach pre-pandemic levels until 2025, as new supply will likely absorb much of the demand growth. Miami has more rooms under construction than any market in Florida and one of the busiest pipelines in the country. Rooms under construction in Miami hospitality market represent more than 6% of the current industry inventory and more than double the national rate of 2.8%. Like I said, that's from Daryl Cronk, Director of Hospitality Analytics, South Florida. Check out his video over on CoStar's platform. Now, for our next article by the South Florida Business Journal on the commercial real estate, price to rent single-family homes in South Florida up as much as 40%. So we've been talking about the migration to Florida since the pandemic, and investors and businesses and individuals and families migrating 1,000 people per day, South Florida absorbing approximately 34% of that. Well, with people, it creates demand. With demand increases price inflation, especially when we're in a 40-year high of inflation. And the Fed's just increased federal fund rate yesterday for the first time since 2018. This is what happens. Miami-Dade County has home to the highest price increase for single-family rentals in the nation, according to a recent report from property information data analytics company CoreLogic. Rents rose $38.6 to $2,400 a month between January 2021 to January 2022. That's year over year in Miami-Dade County, the highest percentage increase out of 20 major metro areas examined in March 15th study. The year before, rents for single-family homes there were up just 2.2 year over year, pretty typical and average. Nationally, the average increase was 12.6%. According to Irvine, California-based company, the year before, rental rates for single-family homes across the nation rose 3.9%. Renters in Broward and Palm Beach County were not spared from the rate hikes. During the same time period, the cost to rent homes with at least 3 bedrooms in the respective counties rose 23.9 to a median price of $2,400 a month and 25% to $2,700 a month. Housing costs throughout the Tri-County area have increased as more people, particularly wealth transplants from out of state, moved to the region. This trend accelerated after new tax laws championed by the Trump administration limited federal deductions for state and local taxes to $10,000. Florida has no income tax, and the migration was further enhanced during the pandemic. Brokers have told the Business Journal. It's led investors to pounce on opportunities to buy and develop apartment buildings locally. This migration has pushed up housing costs in single family and multifamily buildings, forcing the average South Florida renter to spend more than 23% of their income on rent, according to a separate report from National Association of Realtors. Apartment rents increased 19% in Miami-Dade and 23% in Broward and 31% in Palm Beach County as of the fourth quarter of 2021, according to the National Association of Realtors. In comparison, multifamily rents went up nationally 12% in the same time period year over year. Most of South Florida's single-family home stock is either owned outright or used as STR, short-term rentals, via platforms such as Airbnb. The CoreLogic report only counted homes that are leased out for more than 6 months, which is typically 27% of Miami-Dade's single-family home stock, 29% of Palm Beach counties, and 21%. It means only 20 to 30% of the stock is leased for more than 6 months. Everything else is STR, short-term rentals. Still, those homes saw much larger rent appreciation year over year in January 2022 than other major metro areas, according to CoreLogic. The second largest rent increase outside of South Florida was 19% hike in Orlando, Kissimmee, Sanford metro area, and Central Florida. Renters in Phoenix, Mesa, Scottsdale, and Arizona saw rents increase by 18.9 year over year in that same time period. Other metros that had significant rent increases for single-family properties, according to CoreLogic, include Las Vegas, San Diego, Austin, Boston, Dallas, Atlanta, Tucson, Charlotte, Houston. In terms of dollar amount, 5 metro areas have higher rates for renting out single-family homes as of December 2021. San Diego, Los Angeles, Seattle, Honolulu, and New York. This comes from the South Florida Business Journal. Eric Boninsky, reporter. Great article. Rents are increasing as migration increases. Rents are going to increase. And now the next article is very particular because we see hotel is doing good in Miami. Rents are increasing on single-family housing. Migration is increasing. Rents are increasing on multifamily. But a different index, the home builder confidence, slides for a third straight month. This is an article by The Real Deal, written by Holden Walter Warner. Cool looking picture. Some distressed, I don't know if he's supposed to be an architect or a builder, or let's get into this and see what they have to say. The National Association of Home Builders, Wells Fargo's Housing Market Index, which tracks home builder confidence in current and future single family home sales and traffic of potential buyers, slid for the third month in a row. So they're building less. More people are moving. The prices are going up. The index dropped 2 points from February's revised total, bringing the builder confidence to 79 points in the first time, and the index dropped below 80 since September. Some current factors appear to be in builders' favors. Demand for homes has remained high amid historic lows in inventory, creating opportunities for people to quickly snap up newly built homes. For sale inventory dropped 31% in fourth quarter, hitting a historic low of 750,000 units nationwide in December. Inventory dropped 26% during the year, according to Zillow. But persistent supply constraints are among several factors cited in the declining builder confidence. Other factors including rising construction costs and federal policy. Builders are reporting growing concerns that increasing construction costs, up 20% over the last 12 months. But if costs are up 20% and prices are up 24%, you would think this is kind of a wash. It says increasing construction costs and expected higher interest rates connected to tightening monetary policy will price prospective homebuyers out of the market, said National Association of Home Builders Chief Economic Robert Dietz. Now that's true. So construction costs are going up, but prices are going up. But also the cost of that money to buy those houses is also going up, which puts downward pressure on the amount, the payment the individual buyer can purchase with their purchasing power in their submarket or neighborhood or metro. Now, let's see what's going on at the Wall Street Journal. It's been a heavy week. Look at that 10-year. Whoops. There we go. U.S. 10-year Treasury note, Wall Street Journal markets. This is Friday, March 18, 2022. 2.142. It's a 10-year over that 2% mark. And you know what? I don't think it's going to go by. I don't think it's going to go back down. We're going to keep an eye on it. Let's switch over and see the mortgage rates. It says today's national mortgage rate trend. Got that 30-year fixed up at there, 4.47. I'm not a big fan of that going up. I'm looking to refinance my townhouse, little beach bungalow soon. And man, rates will keep going up. It says for today, Friday, March 18, 2022, the average rate for the benchmark 30-year fixed mortgage is 4.48. You know, the chart indicates 4.7, but hey, up 16 basis points over the last 7 days. If you're looking to refinance your current mortgage, which I am, the national average 30-year refinance rate is 4.46%, up 14 basis points since the same time last week. Meanwhile, the national 15-year refinance rate is 3.74. Maybe this isn't something I should look up 15 basis points over the last 7 days. Whether you're looking to buy or refinance, Bankrate often has offers below the national average to help you fund your home for less. I'm David Magard. This is Property Value that you've been listening to. Hope you have a very beautiful day. Enjoy your weekend. I'll see you on Monday. God bless.